Hi, my name is Sakine. I'm the founder of Tax Formations, which is a tax consulting firm specializing in entity and transaction structuring. Today's video is about how to distribute income from a U.S. partnership with both foreign and domestic partners. And in and the way I'm going to conduct this video is through a case study. So recently I had a client come to me. He has a partnership with his three sons. It's a U.S. partnership. The three sons live in the U.S. and are subject to tax in the U.S. And he lives in Dubai and is subject to tax in Dubai. So his first question is how to distribute income to his three sons. What is the best approach if you're looking for tax savings? So I really liked this case study because they're family members and they're all working together, and to a certain extent, money lost by one but earned by another. If more is earned than lost, they're willing to consider factors like that. So there's a lot more tax planning flexibility when you're kind of working with a family who considers each member's family theirs as much as the other members. So basically, I told him for his three sons, there are two standard ways to distribute income. One is through salary, and the other is through dividend distributions. I recommended that of those two options, he distribute income through the LLC, distribute income through dividend distributions, because dividend distributions are subject to tax at ordinary income rates, whereas salary is subject to tax at ordinary income rates plus self-employment. So there's higher taxation on salary. Let's go with dividends. Now, the third option that I offered to the taxpayer as a way for the LLC to distribute income to his three sons. His three sons all have their own LLCs. So I suggested that the sons exchange shares in their LLCs for the income that the partnership is looking to distribute to the sons. Now, hypothetically, in this case, the LLC shares aren't valued very high. They're they're going to be valued lower than the income received. So in this case, the taxpayer's three sons would pay capital gains tax on the difference between the value of their shares transferred in exchange for the funds and the amount received. So this is a more creative distribution idea. It results in the best tax outcome because now the three sons are only paying capital gains tax on the income received. But it things that you have to consider are okay. So now the partnership has shares in these Sons LLCs. So we have kind of engaged in a restructuring. Now the partnership is part owner of these LLCs. So the taxpayer had to consider whether they were willing to have this kind of reorganization occur attendant to the distributions solely to take advantage of tax savings. So that was a decision for them to make, but I just gave that as an option because it was the best tax savings option. The next question was how to distribute income um, to the um, to the foreign parent who lives in Dubai. Now, the two main methods are through dividend or salary. And then, of course, there is that share exchange option, which is kind of like my creative option, um, but which comes with a restructuring. And, you know, sometimes you'd rather make a decision based on operations and structure instead of tax savings. So, so for the foreign owner, I I first started by analyzing the tax implications of the two standard income distribution methodologies, which are dividend distributions and salary distributions. So, in his case, if he were to receive dividend income from the U.S. partnership, the income would be considered U.S. source because the business has a physical warehouse in Virginia. And that physical warehouse um, makes the income, gives the business substantial to the United States, income earned through the partnership U.S. source. So because the income earned is U.S. source based on this Virginia warehouse, the Dubai taxpayer would have to pay tax in the United States on the dividend income at ordinary income tax rates. Not the greatest tax result for someone who lives in a tax jurisdiction where he doesn't have to pay tax. Now, with salary, the sourcing rules are you source to the location of the services provided. Because he lives in Dubai and provides services from Dubai, the income would be sourced to Dubai in the event that it's distributed via salary. And as Dubai doesn't have income tax, he's not subject to tax in the US or Dubai as a result because it's considered foreign source. So that is definitely the option for him. And I didn't even really consider suggesting an exchange for shares because that's capital gain and the salary was awesome because it's zero tax. So those were the recommendations that I made for the distribution of income in this case study. I'd say generally the best way to distribute income is a facts and circumstances analysis. It really depends. Are there foreign investors? Are they all in the United States? There are so many factors to consider. But this kind of work is what I specialize in and enjoy the most. So if you have any questions or would like to discuss further, please feel free to reach out to me. My information is in the contact box below. Thank you.